buying a lot of stuff at the bottom edges. And you're saying, but is it not still bearish? Yes, it is. It's still macro bearish. So whilst you might be buying bottom edges and you might start working bottom edges, you really need to start demanding risk premium. You really want to be demanding a premium or a discount, in the case of a buy trade, of course. You need to want to demand those extra prices to take advantage of what is quite clearly a bearish macro marketplace. And if you don't get those big macro discounts, you shouldn't be even attempting to buy into this trade. You should be selling down into the lows for the guaranteed discount to appear. So when we understand this, we start understanding a little bit more about the logic of understanding the big picture macro and the short-term micros. This is what we start to recognize as the reality of what you see on your screens. And John made a point about the references. Where's the reference? Well, the reference is depending upon your time frame of reference, of course. The reference is, if you're trading obviously on a 1 minute chart, you're not going to want to see this on a 5-year chart. It doesn't make any sense. It doesn't make any relevance to what you're looking at on a chart. But the last 24 hours for that swing does have relevance for the gold market. And as a result, the last 24 hours or so seems to be a relevant picture to try and figure out what the bullishness and bearishness of the market is. And we can start building out the picture around those ideas. So you've got to start recognizing this stuff, guys. You've got to recognize this big minus development in here where there's nothing going on up here. That's the bears. That's where the bears are. And selling down into these weak-handed buyers, that's also part of that story. If the buyers are weak-handed, they're always going to get pushed. They're going to get pushed. They're going to get pushed until you get down into guaranteed prices. Why guaranteed prices? Because obviously in this area here, guaranteed prices gives us an idea that when the market goes back up, the guaranteed discount on price gives us an exit for the big commercials who are macro short, an exit, not a net long position for the macros, an exit for the shorts. And if they've got a big size on, they'll be taking a big size off. That's going to put a buy side boost into the bottom edge of your equity price or your gold price or your oil price. So you've got to make sure you don't lose sight of what the macro is. Now, some people might say, yeah, my time frame is different, Ray. Okay. So your reference says to you, right, I'm going to be trading this as the macro bottom edge, and I'm going to trade this as the balance area here. So I'm going to trade my macro as this. Okay, but I'm not arguing with that. That's a possible macro. Absolutely. But it's also a little bit stupid when you're using the overnight session to try and figure out what the macro and micro is. Whereas when I'm using this, I'm using the whole US gold session, the big volume session, to figure out what the macro and micro is. Makes a lot more relevance to recognize that that trade there is a hell of a lot more important than an overnight rally where there's no bloody volumes. That's my trade in there. That's the picture I'm using to figure out what the market is, what the trade is. So when you start recognizing that there are opinions, there are differences of opinion when you look at these markets, we have to accept and understand that that's the case. But in the case of gold, you've got to be able to look at all of these elements. It's not just one, it's all of these elements. So when you look at the gold market, we'll come back to the gold market, of course, because it's a very, very good test case for people to understand this whole concept of micros and macros. If you understand those, you're well on your way to being able to trade these things, guys.